Thank you. Hi, everyone. Welcome. Thank you for joining us today, wherever you are. I appreciate it. My name is Alistair. I'm editor at Venture Capital Journal. I cover venture financing and what venture capitalists are up to today, which is plenty. Again, thank you for joining us. We're going to hear from our panelists in just a moment. We'll introduce them and we'll get started on the webinar. Just a bit of housekeeping. If you have questions, feel free to type them in confidentially at any time during the presentation, and I'll either incorporate them during the discussion or take a break at certain times and read the questions to our two panelists. So let's get started. Anis, why don't you kick us off, tell us who you are, and help set the stage for today.
Hello, everyone. My name is Anis Uzman, and I'm the founder and general partner at Pegasus Tech Ventures. I'll show you a little bit about Pegasus Tech Ventures. So we are based in Silicon Valley, and we have been investing from early to late stage. Indeed, we have a very unique model where we manage the capital of many large corporations around the world, and we actually bridge them with the top startups. In the process, we have ended up making 200 plus investments. We have 30 funds running in parallel, about $1.7 billion under AUM. And we actually not only invest in these startups, we actually help these startups work with one of these corporations. So that's how we call our business as VC as a service in some sense. We have received capital from a lot of corporations. As you can see, a lot of corporations from Asia who have been working with us, about 35 of them. And we have also had the opportunity to work with a lot of great brand names in the startup arena. We have been able to invest in companies like SpaceX multiple times. We've been part of 23andMe and SoFi. And we're also proud investors of companies like Calm and Headspace. Recently, we're very proud of investing in a company called Rigetti, which is one of the largest quantum computing startups in the world. And they're expecting an IPO, I think, recently. And we have been able to invest in them when they're at seed round. So as you can see, we invest in all sectors. And we also happen to actually run a program called Startup World Cup to foster innovation and entrepreneurship around the world. So we actually do this in 60 plus countries, bring all the champions to Silicon Valley and do a grand finale at San Francisco, give out $1 million in prizes, in investment prizes. So that's what we do actually to foster innovation and entrepreneurship. And I think I also wanted to hit a point here is that today we'll also talk about investment from special VC funds, which is VC as a service thing. As you can see that if you look at the CVC deals, the number of corporate venture capital deals that have grown up really significantly. As you can see in 2021 H1 first half, the venture capital investments from the CVCs have gone up to $79 billion. And also the deal count has gone up by 10%. I'm sure that we'll hear about this part and talking about investment from corporate venture capital quite a bit at today's panel. That's in a nutshell about Pegasus Tech Ventures and myself. Thank you. Happy to be part of the panel.
That's great. Terrific. And I just wanted to say, I forgot to say what the topic is. We're talking about founders market, how strategic capital thrives in today's world. And so that's why the emphasis on strategic capital, on corporate venturing. Tim, please introduce yourself.
Thank you, Alistair. Jim Crenn, I'm a partner in the corporate group at Morrison Foerster in our San Diego office. We're a leading global law firm with over 1,000 lawyers and 16 offices around the world. We work with some of the world's top companies on their most important and complex transactions, litigation, and IP-related matters. This includes not only top established companies, but also emerging companies that are creating the next great generation of technologies and investors in those companies as well. I personally focus on mergers and acquisitions and working with emerging and established life science and technology companies throughout their life cycle, from formation to exit. We guide them through all of their major capital raising rounds, from that first seed round to raising tens or hundreds of millions in later stage rounds to going public and beyond. We also focus on working with venture capital and strategic investors in those companies and acquirers of those companies as well. So I'm excited to be here today talking about the current state of the venture financing industry.
Yes, very good. And before we get into that, just a reminder, as I see the number of participants are increasing, just a reminder, you're welcome to type in a question at any time confidentially. Only the panelists can see the questions. But you're welcome to, I like engagement, and so if you have a question at any time, feel free. Tim, you mentioned the state of venture capital, and it's certainly a robust market. Just taking everything, I mean, not even factoring in pandemic and work from home, not even talking about inflation, just looking at the word I like to use is robust. Just a lot of fundraising, a lot of exit activity, a lot of deal activity. A question for both of you, just, you know, what is your take? What is the state of all the unlimited capital now for entrepreneurs? What are the two of you saying? Either one of you.
Sure, I'll jump in here. Nanish, feel free to add. You know, you're right that there's been record-setting investment. You know, through Q3, I think there've been over almost 240 billion deployed according to PitchBook, and we're seeing that strong levels of activity across all stages. You know, from seed to late stages, and in many different industries and sectors as well. You know, while much of that capital has been deployed in the 100 million plus mega rounds, of which have proliferated in this period of time, the number of deals, including early stage seed deals, has also risen at a really strong clip. You know, this is in part, I think, been driven by huge raises by VC funds. They've used the favorable exit environment to raise unprecedented levels of VC capital, you know, building off the strong IPO market and the robust M&A market that's driven LPs to continue to allocate more and more funds to the space. They've raised over 96 billion, I believe, in 2021 through Q3, and increasingly large and concentrated funds as well. You know, we're also seeing really strong participation by non-traditional investors, crossover funds, hedge funds, you know, corporate venture capitalists, PE fund investors, asset managers. These investors continue to increase their funding levels, surpassing previous yearly totals by the end of Q3. They're participating in over a third of deals. They're participating in a lot of the larger rounds, over 50% of later stage deals. You know, just as an example, according to recent Silicon Valley Bank report, there are now over 4,000 corporate venture capital funds globally. So just really seeing an explosion here that's led to increased activity, increased round sizes, and increased valuations.
To add to what Jim mentioned, I also actually had a chance to look into some data from Crunchbase, and I found out that by the end of the third quarter, the new amount of new investment globally was 454 billion. If you look at the numbers from 2020 for the whole year, that amount was 332 billion. So things have gone up significantly as we close the year. Most probably the venture capital investment in startups will be almost double of what we had in 2020. The other thing that we also was interesting in Crunchbase is that if you look at the number of new unicorns globally, as of end of Q3, there were about 413 new unicorns that was born. Whereas in 2020, in the whole year, we had about 165 new unicorns. So the number of new unicorns are also growing. We talked about the investment in the first 3 quarters, $454 billion. Another interesting data point was there that 64% of those companies actually raised more than $100 million. So that's actually also a huge thing. Now, as a VC, I am also looking at my competition and, you know, looking at what other VCs are raising. So I also looked into that data, and it looked like in the first 9 months globally, VCs actually raised more than $96 billion for their funds across 526 funds. If you look at that same data in 2020, in the whole year, VCs raised $85.8 billion across 665 funds. So the VCs are also raising money. It is not only the startups who are raising money. So it is a pretty, like, I will say, the good market. In some sense, I'll not call it a strange, but it is a good market. I hope the hype keeps on for a while and we enjoy the market. I mean, we are part of this game actually in this point.
Lots of activity. What perhaps by the end of the episode we'll know what your outlooks are for next year. But just staying on topic here on all the venture capital, on all, not just venture capital, on all kinds of capital. Jim, you mentioned the non-traditional investors. A question again for both of you. What's popular right now? Is it for the entrepreneurs who are dialed in? What is the best? What's the best kind of capital? What's the most popular kind of capital that you two are seeing?
Sure, I think it's both and others. Everyone's joining the party. It's really a strong activity across these different levels. When you look at the level of dry powder, not only at venture funds, but at these other non-traditional investors for investing in this space, it's at record levels across both. And just as two examples, I have a client doing an early stage seed round in which the CEO is considering offers for the lead investor from an angel group, a traditional VC, and a strategic. I have another client that's doing a Series B round in the life science space, and they're looking at having a PE fund as the lead investor that traditionally wouldn't be investing in this sector at this stage. So you're really seeing very strong levels of activity across sectors, across stages, and across types of investors.
So to add to Jim's point, I also like the idea that when you're raising capital, mixing it up a notch is a good thing. Traditional VCs definitely people get started with, but also taking strategic money. So I will talk a little bit about the corporate strategic money.
Great.
So corporate venture capital is something that can be a pretty good way of raising capital for startups. Corporate venture capitals, when they invest, they also have a strategic goal to work with the startups so that the startups can not only get the capital, but they also can get strategic help, support, and also can rely on the experience of the large corporations in some sense that can help them grow and also partner. So I know that most of the strategic capital comes into the startups traditionally at the later rounds, but also getting started at an early round at this phase is not a bad idea. I think some of the data will come up later, but I think according to PitchBook, 25% of the 2020 all investments were made by corporate venture capitals, which is a strategic capital. So that actually tells that the corporate venture capital space is getting really active, and I think all of the entrepreneurs and the startups should take that opportunity as well.
On the theme of corporate venture capital, Anis, are you seeing it in all stages?
Yes, we're actually seeing it at all stages. Actually, I personally managing Pegasus Ventures, which is actually a VC as a service company. So we actually manage 30 funds. We're running this 30 funds parallel, and all of these funds we're running it on behalf of a certain corporation around the globe. So if we look at their interest level deeply, we see that they're asking us to invest in the sector of their choice for sure individually, but as we're investing in a certain sector, they want to invest at a seed round to a Series B, C, D round, because they want to actually mix it up in a good way, because it becomes very competitive for them to get in at the later rounds. They want to have be part of the game for certain startups from the very early stage. We have seen them investing heavily in Y Combinator companies, Techstars companies, 500 startup companies. We're seeing that. So we originally thought that they would like to work with more Series B, C, D companies because the product and technology is more matured at that level. But we're also seeing that they're investing at the early rounds nowadays, especially for the last 2-3 years. We have seen that change in corporate venture capital, our goals and objectives.
This kind of relates to a question I see someone asked about what industries are we seeing? Specifically, this question is in regards to pre-revenue funding. I mean, pretty much we're talking about all industries are seeing a wealth of activity, right? There's no there's no one that's I don't know. Maybe you guys have seen something differently. Is there any one industry that is tops right now?
So I'll jump on that in the first,
Please.
actually. So we are seeing that, so we are representing many corporations across all different disciplines. So from healthcare, IT to fintech to, games and entertainment, right? So we're seeing it all. But recently, we're also seeing interest in some new areas. For example, space exploration has become a new topic for many of the LPs. Quantum computing, we are seeing a lot of interest in quantum computing. Recently, just like last month, we have been told by our LPs to look into companies related to metaverse, entertainments and gaming, because we're representing some corporations like Sega and Bandai. They want to look into that space. So yes, we are seeing a change as the technology is also changing, as the demand for technology is also changing in this space.
I would just add that in addition to the technology side, the life science side has remained very robust throughout COVID, really, but continuing at a very, very healthy clip during this side, and it's across all areas within life science. And I expect, I think, Alistair, you mentioned kind of trends going forward, and Anish, you touched on this as well. Not just corporate venture capital funds, but other investors. We're seeing a real movement of investors that traditionally participated at a certain stage, moving earlier and earlier in the life cycle, really trying to get in at that ground level. And that's not only strategic investors who, while the bulk of their capital is still going to later stage rounds, they're investing with increasing frequency at early rounds and leading those deals with increasing frequency as well. We're also seeing investors that used to be public company investors move to be crossover investors, who have moved to be later stage investors, who have moved to be early stage investors. So there's been this trend of larger capital funds who participate at later stages, moving into the earlier rounds, which has, and really across industries, which has really driven the size of those early stage rounds and the valuations in those early stage rounds as well.
Mm-hmm. We've seen a lot of large venture firms launch seed funds this past year as well. That's a part of it. Neither one of you, a great list of industries you both highlighted. Neither one of you said Climatetech. Are you seeing anything in that regards?
Carbon control is definitely becoming a topic. We are seeing some activities there. I did not mention that previously, but we're seeing a lot of focus. So we have a bunch of corporate clients who are in the automotive space. So they're very much into finding out the next generation battery technology to, they're also interested in hydrogen cell, technology. That hydrogen cell technologies comes with its pros and cons. So they're looking at like, what are the startups who are coming up with safe hydrogen cell technology in some sense, that can be used in the automotive space. So yes, we are seeing some focus on the clean energy space as well, and green tech, you can call it, because there's a lot of focus for most of the corporations on the ESG side because of the 17 mandates by the United Nations. Yes.
Yeah, and I just add to, artificial intelligence has remained strong. Ag tech continues, and then food tech as well is increasingly getting some larger rounds at very healthy valuations as well.
Oh, very good to hear. Very nice. Going back to you, Anis, a question I wanted to ask you and related to Pegasus is venture capital as a service. What is it? How can this benefit startups and the corporations you work with?
So we started the firm in 2011, and we started this service called Venture Capital as a Service, where we're helping a lot of large corporations running their open innovation in some sense. So what they do, we create a fund for them. So basically the CVC that most of the corporations create on their own, we actually run it for them. So we build a fund, we do everything from deal sourcing to due diligence. We work hand in hand with the corporation and we make the investment. We also get their feedback as we make the investment. obviously we're investing from each fund in the certain sector that they are interested in. And we keep in touch with them. We make sure after we finish the investment, we also try to connect the startup with one of the corporations where the money came from, where the capital came from. So this model has worked out really well for us. We started with only a single corporation from Europe at the very beginning, and then we ended up with 35 corporations today, and we have some big brand name like who are behind it, who are actually taking advantage of this. The reason why corporations are doing that, sometimes they do not have access to all the top deals globally. It is not possible for them to put together a 100+ people team across the globe so that they can tap into the top technology and business ideas and business models around the world. We happen to have presence in 16+ countries today, and we have been able to not only show our customers or our limited partners deals from the US, Silicon Valley, but also showing them deals from Israel, showing them deals from Southeast Asia, from Japan. So we have given them a big sourcing mechanism, provided them with a professional due diligence process, and that's what is becoming very popular with the corporations.
Mm. And you work with, excuse me, you work with the corporations you work with. You work on a range of stages, correct? And sometimes, yeah, sometimes they'll lead, sometimes it's co-investing, correct?
That's correct. So most of these corporations actually will start with a fund in the size of 30 million to 50 million, sometimes 100 million or more. These funds tend to be evergreen funds. So once they complete the fund, they actually just extend the fund, because this is a one-on-one relationship with each of the corporations. It's a private fund for each corporations. We have seen the corporations are investing. Sometimes they're leading, sometimes they're following. We have seen both sides of it.
With all this, for both of you, with all this capital out there, different sources, what considerations should startups be, mulling over when there's just this wealth of capital available in the market? A question for both of you, but let's start with Jim. Any thoughts there on, considerations, best practices for startups when evaluating so much capital?
Definitely. I was just talking to CFO of a client the other day who's in the process of putting together their round, and yes, they want to raise capital, but really it's starting with what are you looking to add in terms of value with this round beyond the capital? Are you looking to augment the board with either corporate or strategic experience? Are you looking for commercial connections? Are you looking to boost credibility and positive PR? And you want to, as Anish mentioned earlier, you want to look at the portfolio of investors you're bringing in addition to your lead investor, to try to achieve that value, again, beyond just the capital, when capital is in good supply. VCs can bring some significant pros in terms of experience across portfolio companies, additional funding and resources with reserve funds for follow-on investments, and in many cases, connections. But not every VC has strong industry and strategic experience in that particular industry. And for some companies, there can be concerns about business model fit to target venture capital returns. That profile that they're looking for is they're not looking for singles or doubles or get really home runs. They're looking for grand slams. So you want to make sure you're the right fit for the investor that you're looking for. Strategic investors have many advantages in terms of industry and technology validation, strategic guidance, access to commercial opportunities, sometimes a focus on long-term product development, the potential for an evergreen balance sheet, and there are also potential exit opportunity down the road. But you want to choose your strategic investors wisely, just as you choose your venture investors wisely, because they're a long-term business partner. They may have differing long-term strategic objectives. You may be in their product development plan now, but by the time that Series B rolls around, their plans may be different, because you are going to be subject to, in some cases, some shifting corporate priorities and funding. You really want to think about some of those additional rights you grant to strategic investors. Often, in addition to the main financing documents, there'll be some other bells and whistles that strategic investors will want. Sometimes those will relate around acquisition opportunities or restrictions on funding or commercial deals with competitors. That can have a chilling effect on your future activities. You want to really be ensuring that the investors that you're bringing in, one, are helping you achieve those value objectives that you set out with the round, and two, are folks that you really believe are going to be really strong business partners for you in the long run.
I think Jim covered it very well. So I second to him that, raise smart capital, right? I know that you're seeing a lot of capital in the market, but when you are raising the capital, raise very intelligently, raise it from the right partner who can not only provide the capital, on the industry. So what you can do, because there's enough capital and you never know after 18 months what's going to happen. One idea that I'm always telling to my startups that I'm actually helping and advising is that stretch that 18 months to maybe 18 plus 9, like maybe 27 months, and raise a little bit more capital. Maybe stretch your goals. I know that there are milestones that we actually follow. Like when you are at Series A company, you're going to Series B, you have a milestone that you want to see a prototype, you want to see 2 customers maybe. Maybe if your goal was originally that in 18 months, I want to engage with 2 customers, stretch that to 4 to 6 customers, and for that you will need not 18 months, maybe 27 months, and you will need more capital. So when you can raise more, please raise a little bit more. I will also request all of the entrepreneurs to be actually careful of how much equity you are giving away. So price the round well, so that you do not give away too much equity at an early round by mistake, so that when you will be needing more and more capital to grow, you might not have enough equity to play with. So doing the financial modeling intelligently with some experts, I think will be a good idea. Like I know that Jim and Morrison Foerster actually can also help you with that financial planning, putting together a cap table. I will definitely work with some experts, with some people who can actually help you with the financial planning, because I see a lot of very promising startups that do not end up doing well because their financial planning and cap table management was not good enough at the early stage.
A very thorough answer from both of you on consideration for startups. Just and I see some questions from the audience. Thank you. We'll get to those soon. Staying on this topic of evaluating potential investors, are you traditionally CVCs were more on the strategic side, on the later side? Are you seeing that more on the earlier side, seed stage side? Excuse me.
I'll take that question.
Sure.
Yes, thanks for that question, Alistair. Yes, I mean, traditionally, corporate venture capital or the strategic capital comes in a little bit later stage. So it is Series B is the most preferred stage. And I will tell you the reason the corporations want to work with you together. And for a corporations to work with you, they want to see a product that is already available in some sense. And up until Series B, in most cases, traditionally, you do not have the product ready for use. So that is the reason. But we are also seeing one of the trends where the deals are becoming very competitive at Series B. If I put myself on the venture capital issue, it is so difficult to get into Series B, C, D deals, because there are big players who are actually betting in a big way, and we need to compete with them as well. So getting into early rounds, that's why it's becoming more popular with the corporate venture capital and the strategic investors. So you'll see a lot of seed and Series A round deals nowadays from the corporate venture capital sides as well.
Yeah, I'm smiling because non-traditional investors who are typically in those later rounds, B and C, are going a little earlier. So that's just increasing the competition earlier. And then just staying on this topic, Tim, you mentioned, in considerations for startups raising capital, you mentioned board construction. Does that kind of go in hand with ESG factors, or rather diversity and inclusion? Is that where that comes into play? Are you seeing more startups concerned about that?
You're
when raising
seeing,
capital? Yeah.
you are seeing more focus in that area. I mean, for many private companies, that board composition is set contractually. The investors get, each lead investor is going to have the right to designate a board seat in general. And so there isn't as much necessarily flexibility on that side in many aspects, because you're working with a varied group, but there is more focus on the area. And you do see, as the competition has heated up, you do see more investors trying to distinguish themselves in ways of how they can add value, whether it's, again, through strategic guidance, through diversity of viewpoints, or other ways. And you are seeing more strategic investors too take seats on the board. We tend to lump corporate venture capital funds or in one category, but there is a pretty large diversity across those in terms of where they fit within the financial versus strategic spectrum. And it is really a spectrum, with many being sort of a hybrid of those two. And there are some variances in terms of participation on boards based on if they're kind of a pure strategic or more financially motivated as well. But you do see investors looking to distinguish themselves. And I'd agree with Anish, we're seeing that move earlier in the stage. And you're seeing even venture funds adopt different models to account for that as well. On the life science side, you've seen many of the major funds adopt more of a venture creation model, where they're actually creating companies now, co-founding those companies, where they find a science, they license it or acquire it, and they build an executive team around it, rather than just investing in a new company. They're really co-founding those companies. So that's another aspect of kind of getting in at the ground stage. They're creating the ground stage to do that. And so we're really seeing that across industries, and then seeing investors think about and position themselves to demonstrate to companies how they can add value. I would be, as we talk about this abundance of capital, though, I would be remiss if I didn't talk to the entrepreneurs who are those first-time entrepreneurs raising funds. Yes, there's a lot of capital out there. If you're a repeat entrepreneur who's had a great success, is it easy to raise fund? Yes, it's a great market to raise fund. If you're a first-time founder trying to raise that first institutional round, is it easy despite the level of capital out there? No, it is not. It is still very challenging. You still have to work very hard to do it. It's going to take longer than you think. It's going to be harder. You're going to kiss a lot of frogs in the process. But it is, notwithstanding that capital's out there, we're not saying that it's easy, particularly if you're a first-time founder trying to raise it.
Agreed. I see that as well. Excellent point. I would like to pause just for a question here. It was in regards to Europe versus Asia. Someone was commenting on the cultural differences in terms of working with strategic investors. Our discussion here has been about worldwide investing, primarily U.S., but with an eye towards worldwide investing. Is there any cultural differences? Honest, perhaps a question for you: is there any cultural differences working with strategics overseas?
Yes, I will actually talk about that. So we started our first fund representing an European corporations, and then obviously we represent customers from Asia. Customers mean corporations from Asia. And also, we represent corporations from the US as well. So we do see a little bit of cultural difference in all aspects. Let's talk about, I think we know the corporations in the US very aggressive, right? They will try to get into the best of the best deals. Do they always want to work with the startups after the investment? It depends. They actually sometimes, test the weather and then wait a little bit. Whereas if you look at the Asian corporations, as they invest in, they're very serious from get-go. So once they invest, they will make sure they will spend quite a bit of time with you. And they will actually go through the POC, which is proof of concept test. In many cases, if it's a technology company, they will actually take your product and technology, go back to, say, Japan or China or Taiwan, and then verify that in their workflow. And this will also give you a pretty good validation in some sense. If you go through that process, this gives you a very early validation for free in some sense by one of the large corporations, like who actually can tell you that whether in the industry scale, this product can be used and scaled in some sense. So they will do that. We have seen similar characteristics from the European corporations also. We have seen that European corporations, they're also focused on the ROI side. They want to make sure that they also, have a capital gain at the end of the day. So the characteristics actually differ a little bit based on which region the corporate investor is from. But at the end of the day, all of them have good intentions, is that they not only want to give you the capital, at the end of the day, they also want to work with you and want to make you successful. They always have assigned resources, I have seen, for you and the startups, so that that assigned resource can be actually made available as the startups needed it. I feel that the best part I see from the corporate investors is that they're willing to put the time and money to run the POCs. And these POCs are invaluable in the lifetime of your startups. You should take advantage of it.
I would just add, I think those are all very, very good points. And I would just add that, there are some different approaches in deal process and terms as well that we see. Some investors from Asia tend to have a higher level of diligence. So they're going to really, as Anish mentioned, they're looking to, many are looking to invest a lot of time and energy both before and after the investment. So that may make the investment process a little longer in the front end as they get to know your company in much greater detail in some cases, but can pay dividends later on in terms of that increased involvement in strategic guidance. Also, anytime you have international investors, particularly corporate international investors that are coming from one geography and investing in another geography, they're often looking at they often have a higher focus in what your strategic plans are in their geography, because that may be a factor that's propelling them to do that investment as they see the opportunity for expansion or partnering in their own geography as well. And so often we see an increased focus on exploring those partnership opportunities or where the strategic direction is in that home market as well.
Very good. Thank you. Thank you both. Going back to considerations of, we talked about considerations for startups. I wanted to flip that and ask about how have investor considerations changed? How you mentioned, Jim, you mentioned overseas investors, they may have a higher, they may look stronger at due diligence. Overall, how has investor considerations changed in recent years with so much capital that they have to deploy? What's changed? A question for both of you.
I can jump in briefly. I think one thing is, again, this focus on how do we add value? Because when there is this intense competition, not only in terms of levels of capital, but valuations as well, you look to set yourself apart and you look to add value. And ideally, you're adding value in a way that is helping you achieve whatever your objective is as an investor, whether that's purely financial returns or whether that's a combination of financial and strategic returns to your either LPs or parent company as well. And so that's thinking about how you position yourself to investor, so that's being more nimble and accelerating timelines, which we've seen across different types of investors. So whereas strategic investors in the past were viewed as maybe a slower process, often more internal decision making. Many, whether it's because they're partnering with someone like Pegasus or just internally, have become much better at being more nimble, at accelerating those timelines so that they can be competitive with the other sources of capital that are out there. If you're a strategic investor and potential acquisition targets is another item that you're looking for. That's another reason we're seeing investments moving a little bit earlier stage with the acquisition market red hot and valuations very high. Some strategics are finding that getting into companies earlier, including at the seed stage, paves the way for those potential opportunities down the road. It's not, when you look at surveys of corporate venture capitalists, acquisition targets isn't at the top of the list in terms of why they're making investments. But there certainly is a high level of follow through and participation in the exit environment, particularly from, again, it varies, but from those that have a more strategic focus in their investment thesis.
Any thoughts on it?
Yeah, to add to what Jim said, I think Jim covered it pretty well. I think one of the parts that I wanted to add to that is that as the competition is getting fierce, I think obviously the corporations are a little bit more lenient with their DDs than they were a year ago. That's the reality. That's a fact. Because the CVCs are also competing with each other in some sense. Like the same startup, if you have a good product and technology, I think you are getting approached by many corporations, and I think they are coming up with their own CVCs to actually invest in you. So we're seeing that a little bit of leniency on the due diligence, the items they want to check. I'm also seeing another thing is that the timeline. I think Jim mentioned about the timeline thing, that many of the entrepreneurs have an idea that the corporations are going to take a long time to make a decision. That's not true. That is the reason they have outsourced their VC operations to a third party like Pegasus, as I mentioned, or some other, VC as a service companies. So they have made a decision to invest $100 million. They have outsourced that bucket to someone else, so the decisions can be made as like any other traditional venture capital. So the timeline problem, the old concept has improved in some sense significantly, and in some sense we are able to make investments even like within like 2 days. I mean, so that's the that's where we are at. We invest in a lot of, for example, seed round companies from Y Combinator, and I think if you're from Silicon Valley, you know that Y Combinator company, from the day they do the demo day till we invest, it's literally 48 to 72 hours if to make a decision. And the CVCs are able to actually create a process with us where they can actually able to make those decisions. And we have invested in more than 40 plus Y Combinator companies with the corporate venture capital model. So it has become very fast. So I will actually encourage all of you to definitely try out this strategic capital as well from the corporate venture capital side as well.
That seems very amazing. I've never heard that said before. The strategics, the CVCs, are more lenient in their due diligence. Again, just to be clear, it's so that they can make quicker decisions on the investing.
Yes, I think timeline actually has been a complaint,
Yes.
Alistair, that has been there for a while. That the corporations you work with them, you are gonna miss the timeline of your round. And I think most of the corporations are also concerned about that they do not want to be living with that reputation, right? So I'm seeing that they have changed the way they have done business. It's an adaptation to the new normal in some sense of the industry, because it's competitive. You have to compete with the regular traditional VCs. You have to compete with the super angels in some sense, because many of the angels are also having hundreds of millions of dollars of fund nowadays, and they can make decisions instantly. So it's a kind of like a change for the need in some sense.
Very good. I see questions pouring in. I wanted to refer to one. I think it was in regards to something. Yes, it was something honest. You said you mentioned a question mentioning LPs advising VCs about their preferences on sector areas like quantum computing, metaverse. Is that frequent? How often do LPs wield influence on investing decisions like that?
So as a CVC manager, what we do also, we have regular sync up with the executives. And please remember that in most of the cases, we're receiving hundreds of millions of dollars per fund from a certain corporations. So it is always the CEO's office or the corporate innovation team basically who's involved. In most cases, the CEO himself actually shows up. So we have actually a quarterly or biannual sync up with the top executives. And the reason we actually sync up with them, we want to hear their vision, what has changed, what they're interested in. So they're always updating their interest areas and always telling us to go after the startups that actually is within their current vision of the company. So it is changing, and it is not like that they actually give us a mandate at the beginning of the fund and they would sit on that for the next 10 years. They actually give us a mandate when they actually start the fund. They tell us, let's go after fintech, for example. Let's go after the Series B fintech. Let's focus on companies in the security space from Israel. They will give us a mandate. But after every 3 months or 6 months, they will come back and add a region or add another area to that. And that's what we have seen from these. So yes, I know that all the trendy talks that are going on in the market, from NFT to metaverse to the space exploration. Jim mentioned about life science, which is a hot topic in the market. Trust me, I mean, every single of my portfolio of CVCs, they're asking me to look into digital health and life science companies nowadays. I actually missed that on my side, but life sciences is becoming very hot. So they're changing it. I'm also seeing that these corporate investors are going out of their boundaries now. A lot of my CVC clients are from the automotive space. We represent a few funds from some of the Toyota groups, and we're seeing that they're getting interested in healthcare, for example, nowadays. They're also getting interested in green energy and clean energy. So those are some of the new areas that they're going out of their comfort zone and exploring at this point.
Very good, thank you. And thank you, everyone. I see a lot of questions pouring in from the audience. I want to be mindful of time here. I see a few questions about venture capital as a service. With 15 or so minutes left, if we have time, we can address those, or maybe people can follow up later at their leisure and find out more about Pegasus. I wanted to move on and ask a question. We've kind of touched upon this, but I want to address it more specifically, a question for both of you. We've talked about how strategic corporations are investing in various stages, and Anis, you've mentioned going after Y Combinator deals. What is the most effective way for corporations to focus on innovation, to be innovative, to get involved in companies? Is it R&D? Is it strategic acquiring? Is it investing? Where do you guys stand? Maybe Jim can lead us off. What's the most effective way for corporations to be innovative?
Sure. What I'd say is that many use a combination. You have traditional R&D to drive core goals and technology forward. You have investment to obtain deeper insight with respect to new technology and verticals, to gain exposure to new talent, to identify new markets, and identify acquisition targets. And then you have acquisitions themselves to bring that technology and people in-house. And that right combination is going to be different for every company, but often it is some combination of those elements and others. I'm working with a CVC right now that actually helped form a company to expand upon a major customer relationship. So companies and investors are getting more innovative too in terms of how they look to drive innovation and drive value. I think the main point is to identify your core goals for each activity, and shape the activities, the resources, and approach to achieve those goals as you look to balance those different approaches.
Sure, everyone has a different goal. Good point. Thank you, Jim. Anis, any thoughts there?
Yeah, we have seen traditionally the corporations have taken advantage of different mechanism in terms of running their corporate innovation. Some of the corporations opened up a open innovation center. They have encouraged ideas from outside. The corporations actually put together conferences, events around those open innovation platform, and that's how they have kind of like gathered the ideas from the market. And we have also seen programs within the corporations, internal open innovation program. We know that traditionally Google, Apple, Facebook, they have always done that, right? And they have been really successful with their different programs they have run inside the company. We also see companies, sometimes they're involved with accelerators and incubators. That's another way of doing it. Running through a corporate venture capital VC as a service is another way of doing it, right? I will also, most probably, if I'm a corporation, I will actually create an ecosystem around me. I will actually, rather than working with my old traditional law firm in my country, most probably I will work with Morrison Foerster, because they are up to date. They exactly know what is going on in Silicon Valley. Working with them, talking with Jim for an hour gives me more knowledge than I could have gained from outside. So I will do that. Creating the ecosystem around it. The people you work with, are they connected to the startup ecosystem is very, very important. So I will take all the measures. I will create the ecosystem around me that can help me out in the process.
What about a question for both of you? What about M&A? that's still an option, right? Although it goes hand in hand with everything that we've talked about here, the working closely, the strategic investing. Are you seeing M&A? Yeah, Honest, go ahead.
Yeah, so I'll address that a little bit. So yes, we are also seeing one of the goals of the corporate venture capital also, please remember, they want to work with you. They want to create joint programs with you, joint development. Sometimes the corporations are also adopting your IP and launching new products as well. So they definitely help you boost up your revenue and footprint. But at the end of the day, they always have the option to work with you in a deeper way, which is like, acquiring more than 50% of your stocks and make you a group company. That is always the option. Some of our investors, corporate investors, they also have told us and given us a mandate that if it is a great company, then we are open to actually buy them out. Actually, I have onboarded a client recently, which is in the automotive space. They have put together $100 million corporate fund with us, asked us to run it. They have also given us a mandate of $2 billion to do M&A. So they told us that we're ready with $2 billion in case there is a good target that can add to our portfolio. We're ready to do that. So we're seeing that more and more. The M&A part is becoming more popular nowadays as we are managing different funds from different corporations.
On that, Tim, did you have a thought?
I was just going to add that that when you look at that exit market, acquisitions do continue to be very robust, but IPO markets are also booming, and so you've got investors and companies really looking at those options as they go forward. Exit values and counts have set records for the first 3 quarters. Much of that value is concentrated in the IPO market, which accounts for kind of the lion's share this year of sort of that total. SPACs, we've all heard about SPACs throughout this process, and they've made a portion of that. De-SPACing transactions, which are mergers with those SPACs, are likely to proliferate in the next few years still, simply because of how much money has been raised in SPACs over the years. We've seen a little bit of decrease in popularity in recent months with some increased regulation and perception there, but still, with all that IPO buzz, it is important, as Anish mentioned, to remember that acquisitions continue to make up a majority of exits for companies, over 60% by count this year. So even though you're seeing lots of buzz on the IPO side, for the majority of early stage companies, their exit event is going to be through M&A at the end of the day.
You read my mind, Jim. I was going to ask about other exit opportunities. On that note, with M&A, are you seeing more? Is it strategic M&A or is it private equity firms?
It's a good mix. Anish made some really good points there in terms of the value and keeping options open that strategic investors do have when they. We had a company that took a seed round investment from a strategic a couple of years ago, and this year, the strategic got to know the company, got to know the technology, and this year did an acquisition of that company for a very great result. I think for all parties involved, you're seeing a lot of good activity at the strategic level, a lot of activity on the financial investor side as well, and it is really a good mix across those two. I think acquisitions are, particularly for strategic focused corporate venture capitalists, because again, there is that difference in models. Acquisitions are always on the table, and we're still seeing pretty good activity on that front here right now.
A question for either of you. SPACs, you mentioned pretty much the rise and fall and kind of how the chilling effect is seems to be taking place with regulation for, foreseeing some regulations on SPACs. Do you see those? Do you see SPACs coming, remaining a strong, viable option next year?
I can jump in, and then Anish, feel free to add. I think that they will still have a significant presence. I mean, one difference between SPACs today versus SPACs 5 or 10 or 20 years ago is just the quality of the sponsors. You have really you look at the life science side and you've got the top crossover investors and venture funds sponsoring SPACs. You look at the technology side and you've got some really strong players there. So, there's a lot of people that kind of jumped in, but if you look at the quality, and there has been some, obviously in the last few months, some issues just in terms of the post de-SPAC performance from some of the companies that's put a little bit of a damper there, but I think you'll still see, maybe not as high of activity as you saw at the beginning of this year where it was just off the charts, but it'll still remain a viable path for companies going forward.
Alistair, can you just keep them for a while? Because that really helps. So we have seen a lot of SPAC. We've enjoyed a lot of recent exits through SPACs. SPACs is definitely a great mechanism to keep in. It really helps the startups who are looking for the next level of growth. It is not only time and cost effective for the startups. I mean, I want the startups to focus on the business, not on the IPO process, because normally traditional IPO process takes 12 to 24 months, and SPAC has been able to reduce that down to 3 to 5 months in some for the startups who are getting acquired by one of the SPACs. So definitely a great thing to have for the liquidity of the business. It definitely keeps things moving forward. As you know that the SPAC market was booming because of the $2 trillion sitting on the PE on the hands of the PE without any exits. So the market wanted it, the PE firms wanted it, and then obviously during COVID, the startups wanted it because they feel more secure going out with the SPAC. One of the things that we're definitely noticing, Alistair, is that after the SPAC, we have seen a dip for some of the companies, and we were actually a little worried that of the phenomena that because everything is on a hype, things are gonna dip down, and then most probably will not experience the same level of kind of market cap for those startups as we have seen in a regular IPO. Interesting things we're experiencing for 6 to 9 months, as most of the lockups for some of my companies which went out through SPAC, as I see that the lockups are dissolved after 6 to 9 months, they're behaving like any other regular IPOs. So I'm feeling much better now after 6 to 9 months from some of my early SPAC exits, that they're behaving like any other companies in my portfolio who have gone through a regular IPO. So I hope the SPAC, this mechanism stays there, because it definitely helps the entrepreneurs. It definitely helps our economy in some sense, because that actually grows the liquidity. And as you see, the SPAC is covering a major portion of the IPO in the US. I think from January till today, we have already seen more than 500 SPAC IPOs, which is like a major portion of the total IPOs that you're seeing in the country.
Yeah, exactly. And just to reiterate Jim's point, with my own editorializing, yeah, despite all the hype around SPACs, a majority of exit, is M&A. I don't think we should dismiss that. Just winding down here, someone asked a question about the highly inflated market we're in, and are we in a boom or bust cycle? Related to that, and thank you for the questions, everyone. Related to that, we're in a founder's market. Strategic capital is thriving. Do you predict that will remain so in the next several months and the years to come? Do you have any, as we wind down here, any outlook on the founders market that we're in, for both of you?
Yeah, I mean, just a couple of points from my end, then I'll turn to Honest, because you're seeing so much activity at the corporate level too, and those insights of where those companies are coming from. I think with the level of dry powder that's out there right now, and the amount of funds that have been raised, not just in the traditional VC space, and that again, that's Alistair, you mentioned some of the big seed stage funds that have recently been raised from some of the top players. Again, it's at all of those stages, but also the dry powder on the non-traditional investor side. I think you'll continue to see that, particularly in the near term. I wish I had a crystal ball where I could tell you where 2-3 years from now where that ends up. But over the next 6 months to year, with that level of capital that's out there, I think you're going to continue to see a lot of competition, a lot of activity.
We all wish we had a crystal ball. Honest.
So to add to that, as you mentioned, that there is a lot of dry powder in the hands of the venture capitalists, right? Just this year, in the last 9 months, $96 billion has been raised by the VCs across 500 plus firms. So we need to use the money. So I will say that definitely for a year or two, this is supposed to stay.
Yes, so much venture capital has been raised, not just here in the US, but worldwide and across all stages. It's hard to see whether they have to deploy it. So yeah, that'll continue. We're almost at the top of the hour here. I'm just curious, any final thoughts related to that? Honest people had some questions about the structure of venture capital as a service, but any just closing us out here. Or are we running until the top of the hour? Maybe I'm mistaken on that. I thought we were, but
yeah, we are. Yeah,
we are. Okay.
We're at the end here, but I think it's just it's a robust market out there with a lot of capital. And whether you're an investor or a company, really think about what value you're looking to either achieve or add to the equation, and really focus your messaging and your positioning and how you're deploying your resources around that.
To add to that, this is high time for both the entrepreneurs, for the investors as well. I mean, let's ride the wave. It is a great market. I think for the startups to grow, this is a great market for the investors to work with great startups. So I will definitely ride the wave, and I hope that this continues to the next year as well.
Ride the wave. Well, sometimes it's turbulent waters, but it seems to be quite an enjoyable ride right now. Whether you're an investor or a startup, there's lots of options available. I guess we're on extra time right now, but this has been very. My tendency is to answer a question, but maybe I should wrap it up. Jim, Honest, thank you very much. A virtual applause to you both. This was very educational and very topical and very interesting. I appreciate it.
Thank you.
With that, I think. Thank you. Very good. I think with that, I think we close it out, and thank you everyone for your participation and for your questions. And who do we flip it to now? Or